All right, let's talk about one of the biggest, hairiest challenges in all of fintech, pricing. For so many founders and product managers, it just feels like this mysterious dark art, right? A lot of guesswork, a lot of anxiety. But what if we could flip that? What if we could turn all that confusion into a clear, deliberate science? Well, that's exactly what we're going to do.
You know, pricing is maybe the single most critical lever you can pull for growth. It dictates your profitability, your market share. It even sends a powerful signal about your product's quality. And yet, it's also the place where so many companies get completely stuck. It feels like you're walking this impossible tightrope between charging way too much or, even worse, not nearly enough.
And hey, don't just take my word for it. This is a well-known problem. CB Insights nailed it back in 2019 when they said, "Pricing is a dark art." I mean, that quote just perfectly captures the whole dilemma, doesn't it? You're trying to find that magical sweet spot where you're not scaring off customers, but you're also not leaving a pile of money on the table. Okay, so how do we actually fix this? How do we bring some light into this dark room? We're going to do it with a really simple but incredibly powerful two-part framework. This is how we're going to tame all that complexity and turn what feels like a total guess into a real, durable, competitive advantage. Here's the big idea, the one thing you really have to get right. You need to separate the problem into two distinct parts. First, you've got your pricing strategy. Think of this as your why. It's your deep-down philosophy about what value even means. And only after you figure that out can you pick your pricing method. That's your what. That's the specific tool you'll use. The key, and I can't stress this enough, is that the strategy, the why, always comes before the method, the what. So let's dive into part one, defining your why. Your pricing philosophy isn't just a random choice, it's a core belief. It's your statement to the world about how you create value and how you expect to capture it. Get this right, and everything else gets a whole lot easier.
When it comes down to it, there are really only three fundamental philosophies to choose from. First, you can be value-based, where your price is all about the customer's perceived value. Or you can be competitive, where you're setting your price based on what everyone else is doing. And finally, there's cost-based, where you just look at your own internal costs and add a markup. Each one of these has a totally different worldview.
So let's look at value-based pricing first. The whole idea here is to tie your price directly to the outcome or the benefit the customer gets. What this does is it completely decouples your price from your internal costs. It doesn't matter if it costs you $1 or $1 million to build. The upside, it's amazing for building loyalty and communicating your true value. The big challenge, though, is that value can be a really tricky, subjective thing to actually measure. Next up, we've got competitive pricing. This is all about looking at the market and positioning yourself against your rivals. It's super responsive, and honestly, it can feel like the simplest option, especially when you're just starting out. But, and this is a big but, you run a huge risk of getting sucked into a price war. And that is a race to the bottom that can absolutely crush your margins and force you to cut corners on quality. And finally, there's the old standby. Cost-based pricing. This is the classic cost-plus model, right? You figure out your costs, you add a nice margin, and boom, that's your price. It's simple, it's predictable, and it guarantees you cover your expenses. But here's the huge glaring problem. It completely ignores what the customer is actually willing to pay and what the market will bear. You could be leaving an enormous amount of money on the table without even realizing it. Okay, so this chart, think of it as your strategic compass. It really just lays it all out for you. If your main focus is on the customer's success, you're in the value-based camp. If you're constantly looking over your shoulder at rivals, you're playing a competitive game. And if your spreadsheets are all about internal costs, well, that's cost-based. You can look right here and see which approach fits best, whether you've got a game-changing new product or you're in a crowded, commoditized market. The goal here is to be honest about where your business truly fits. All right, so you've put in the hard work, you've defined your why. Now we get to shift gears and move to part two, selecting your what. This is the fun part. This is your tactical toolkit. These are the models that are going to bring your strategy to life. You can think of all the different pricing methods as living on a spectrum. On one end, you have total predictability. Think of a simple, fixed price. It never changes. On the other end, you have maximum flexibility, with models like tiered pricing that can adapt to different users. You're basically choosing where you want to be on that line, balancing simplicity with sophistication. The two most basic models are fixed and variable. Fixed pricing is just that, one stable price. Customers get it, it's super transparent, and there are no surprises. Variable pricing, on the other hand, moves up and down based on usage.
People often see this as more fair, you pay for what you use, but it can also get really complex really fast.
Now, to try and get the best of both worlds, we've got hybrid models. You can have a mixed price, which combines a fixed fee with a variable component. But honestly, where the magic really happens for a lot of SaaS and FinTech companies is with tiered pricing. This lets you build out a whole menu of options, so you can effectively serve a wide range of users, from a single person all the way up to a giant enterprise.
And this is exactly why tiered pricing is so powerful. It's brilliant because it lets your customers self-select into the bucket that fits them best. Your basic user gets the core features they need at a price they can afford, while your pro user is happy to pay more for all the advanced bells and whistles. It's a fantastic way to maximize revenue while also making sure every customer feels like they're getting a fair deal.
Okay, this is the moment. It's time to bring it all home and align our why with our what. This is where we put the two pieces of the puzzle together and finally move from that confusing dark art to a truly deliberate, powerful strategy.
This alignment matrix is where it all just clicks into place. Look, if your whole strategy is value-based, then a tiered or mixed method is perfect, right? Because it lets you capture different amounts of value from different users. If your strategy is to be competitive, a simple fixed price makes it crystal clear how you stack up against your rivals. And if you're cost-based, well, a fixed model is the most direct way to just apply your markup. See how that works? It just makes sense. This is what strategic alignment actually looks like.
So let's end on this one thought. The single most important thing you can take away from all of this is to change the question you're asking. Stop asking, what should our price be? That is the wrong question. From now on, the right question, the strategic question, is this: what is our pricing strategy and which method is the absolute best way to execute it? You answer that, and I promise you, pricing will go from being your biggest headache to your greatest strength.